Bharat Iyer of JPMorgan needs no introduction, joins us right now on the show to talk about all of that and more. Bharat, good having you. Thanks so much for taking the time out. Will the party continue into 2018?
I think it depends on what you define as the party. Our base case is that you could make another 10% in Indian equities next year. I mean, can we repeat the showing of 2017? We'd like it to happen, but difficult to predict that at this stage.
Yeah, but would you even like it to happen? I mean, almost everybody that we speak to about valuations looking so stretched that maybe a correction would actually be healthy for the markets.
No, correction at any point in time is good because markets always build up some kind of froth, and it's always good to get rid of it earlier than later. But that said, I don't think we're in obscenely valued territory at this point in time. I think yes, valuations are a tad stretched. We are at the higher end of the historic trading spectrum, one standard deviation higher than mean at 19 times. But that said, I mean, we've touched 24 times in the past, at least on 2 or 3 occasions. So 19 better than 24.
And the guy who's skeptical about this whole skepticism on valuation would argue the same thing, that when we've touched those obscene valuations, we were at the peak of the earnings cycle. Right now, we are not there, and in all probability, earnings could actually revive meaningfully in calendar year 18. So what's your thesis, your individual thesis? Do you think earnings pick up and then continue to move or trend higher over the next couple of years at least? And does that give a floor to the valuations?
See, Niraj, the way I look at it is, we're trading at 19 times. I really don't think there's too much scope for further re-rating on the valuation front.
On the valuation front.
Because, let's face it, valuations were driven by 2 factors. I mean, one was very easy global liquidity and easy monetary policy by central banks in the developed world. That seems to largely be coming to an end. And we've already seen some kind of normalization, at least with some central banks. So I think that variable is out of the way. Secondly, even if you look at it in the local context, I think we saw a very meaningful improvement in local variables, including the fiscal account, the current account, inflation. I think most of that improvement has peaked. And near term, we could see some mean reversion. And even here, I think we're largely done with monetary easing. So I think here onwards, the heavy lifting will have to be done by earnings rather than valuations. On earnings, our take really is that we still think street earnings are a little frothy. For FY18, the street is at about 13–14%. I think for the first half, we ended flat. So I think, the second half, then we'll have to do 25% plus, which looks unlikely at this stage. So I think 8 to 10% is more like it. And for next year, again, the street is at 23–24%. We think it'll be more like 14–15%. But that said, yes. I mean, have we bottomed out and are we going to see a bit of improvement in the trend? Yes.
Bharat, so the process of global monetary policy normalization started this year, actually, in some ways, right? Why is the assumption being made that next year is the year when it will start to bite? Is it because the Fed's balance sheet reduction, sort of moves along? Is it that ECB is expected to join in? Because the BOJ will not.
Yes. I think, it's a combination of factors, Ira. I think what's going to happen is, as you rightly pointed out, central bankers in the developed world were just wetting their feet, if I may use that expression, in terms of normalization this year. Whereas next year, we do expect that this process will gain momentum. I mean, we've seen 2–3 rate hikes so far in the US over a period of 2 years. Next year, our house view is that we'll see 4 rate hikes, though the market at this point in time is pricing in only 2. Yes, as you said, the pace of, balance sheet normalization is, gathering momentum. The ECB will at some point in time join the same stance next year, and the BOE is probably already there. Again, we're seeing something similar from the PBOC. And so I think, with the exception of the BOJ, yes, everyone seems to be moving the other way. And I think, the key data point to watch out for is, how core inflation pans out. Because, we're getting there. And, inflation, as we all know, is a bit of a hockey stick phenomena. And, you just hope and pray that things are normal.
So you do think that fund flows will start to look a little bit softer next year? They haven't been great this year into equities, at least. They've been great into debt.
Yeah, they've been great into debt. But again, let's face it, we still got $8 to $10 billion. Yeah. And if you compare it versus the last 2 years when we were averaging only $4–5 billion, yes, a far cry from the $20 billion we were making between 2000 and 2014 and so on. Yeah. But yes, I mean, we definitely need to watch out for that. That is an important variable.
Interesting. So, Bharat, what goes out faster? Because I remember conversations start of this year wherein most people believed, and I don't know what your belief was, that equity flows were but a derivative of the kind of strong flows that were coming into the debt market. If you indeed believe that debt market flows also will not be that strong, are we to presume that this spate of outflows that we've seen from the equity markets, save for November, could actually accelerate and And people would argue there are factors for that with the rate hike, and maybe the US tax reforms also aids to that process. What is your core belief?
See, I think, if it's always difficult to predict flows, Niraj. I mean, if you ask me honestly, I've been trying to do it every year for a few years, and I've just realized it's a mug's game. I've always got it wrong.
You've given up.
So it take me with a lot of skepticism. But I think at the start of the year, the base case would still be like we do have an internal model that throws out numbers, and the base case we have right now is that we continue to get about $8 to $10 billion into Indian equities next year as well, because obviously, as you said, the global macro situation will get more challenging as we go into the year. But that said, the initial part of the year should still be, quite healthy and reasonable. Secondly, also, I guess fund flows are a function of, some bottom-up stories as well. Even this year we saw, we had a spate of outflows for 3 or 4 months, and then we had this very high-profile IPO, a high-quality IPO, and then it attracted a lot of attention. So, you have to make allowances for that as well. Okay. So, yes, the base case is 8 to 10 billion, more front-ended rather than back-ended, but let's see.
Okay, and part 2 of my question would be, are we now, as a market, reaching a point or have already reached a point wherein the global flows will not really determine or dictate what happens to levels and sentiment, because the locals are coming there. The conversations, and you would have had too, when we've spoken to fund managers and we talk about what will happen if indeed the rates go up and the flows go out, almost everybody has said, hum hai na. We will come in and park in the money because we believe that the flows are here to stay.
See, Niraj, I'll answer that question in 2 parts. I think, first and foremost, the development that you're alluding to is a very positive development. Because, let's face it, the Indian household is underinvested in equities. And, this is a structural trend. It's not a cyclical trend. So, you will see more and more money coming in, and which is good. Because, you want the household to make better money than the debt markets can give them. There is a tax advantage out there. And also, I guess, it's positive for both the markets and the economy, because it enables us to de-risk a little from global happenings. But that said, are we going to be immune to a global sell down just because, local investors have become relatively more powerful? Unlikely. Look at the math. You have the FIIs own what, 22% of Indian equities? The locals, including the Life Insurance Corporation, own 11, 12%, and the LIC is half of that. So, and keeping them aside because they tend to have various considerations. 5 versus 22.
Yeah. And the other point, sir, is, I know I hate to be the voice of skepticism, and we all hope that the domestic sort of, flows continue, but we don't know that they will continue until you hit a down cycle.
True. Absolutely, you're very right, Ira, because, there are 2-3 issues here. Which is what it's a point even we like to make, that, if you're getting, say, $2 billion into equities every month, all of it is not structural. You could argue that, about 800 million is structural, about 1.2 billion is cyclical. And, it's not that the local investor is just going to keep investing in equities at all levels.
Yeah.
This is a very smart investor. Let's face it, between 2012 and 2014, 15, the local investor, stayed away from equities or the financial markets at large, invested in real estate and property, property and gold when inflation was going up, did very well. At the right minute, made the switch into the debt markets.
Yeah.
At the right minute, made the switch into the equity markets. True. So, and the relative attraction of debt is on the margin going up. The 10-year bond has gone up by 80 basis points in the last 4 months. So, yes, that's why, as I said, there is a structural component to it, there's a cyclical component to it. The structural perhaps endures and stays. The cyclical component will have its ups and downs.
Okay. I thought you would have started off with a question
macro?
on banking. No, maybe.
Okay, since you've given me the opening, what is the underlying assumption on macros for next year and how that changes, the way you look at the market as well? So, we're going from a low inflation to a high inflation scenario that has its implications for where you want to put your money. Potentially, we're going into a slight modest, as the RBI governor called it, a modest uptick in the investment cycle.
Yes, I think I would agree with that. I think, on the margin, I think, growth will go up a little bit. Will it go up to beyond, say, 7.5, 8? I don't think so. But, we are aggregating about 6.3, 6.5%. Can that, tend towards the 7% mark or thereabouts? Give or take 20 basis points? Yes. Because let's face it, we've had 2 serious supply side disruptions over the last 12, 13 months. And, both of them will make their way out of the system. And so I guess, initially, there will be some kind of mean reversion. In terms of the future, I think it really depends on, what kind of fiscal space these exercises throw up. I mean, at some point, you would expect them to throw up some fiscal space which can be used to pump prime the economy, but the timing is a little uncertain at this point.
Okay, but would they say, markets start to look a little bit more favorably at the, not core infrastructure, but maybe the ancillaries of infrastructure a little bit?
See, our take on this has been that, look, I mean, at this point in time, there are limited degrees of freedom to pump prime the economy. I think on the monetary side, I think it's largely consensus now that, we're not going to see much happening for some time to come, given the way the inflation trajectory is panning out. On the fiscal side, again, because of these disruptions we've had, I mean, there is limited space to do much. And, what we've seen is, to be fair to the government, they've really not spread themselves thin. They are focusing on 3 or 4 areas, roads and highways, power transmission, affordable housing, defense. So, do we see them continuing to push the initiatives here? And, does that give a leg up to growth? Yes. So I think, it's going to be a limited recovery in that sense. Do we see a broad-based recovery? Not at this stage, because if you see overall utilization levels in the economy are still 75%. Sure. So, I mean, until you cross 85% decisively, I don't think anyone's going to be in a hurry. So we're looking for I would agree with you, we will see a selective recovery. We are perhaps seeing a selective recovery, but it's still not time for a
But consumer investment still in that
consumer
sense.
And select pockets of investment.
Okay.
Yeah, but the markets would probably like to price in something that is not happening or that is not already on the anvil, right? You want to buy into something that will probably happen 6 months down the line because it will be available cheap. Are economy-facing pockets giving you that opportunity?
Selectively, I don't think they're giving you an opportunity where, you can pick something up where a recovery is 6 months down the line. I mean, given the kind of liquidity we have, I think, those stories are all priced in.
Priced in? You think infrastructure is priced in?
I think, again, if you're looking at anything which is going to recover in 6 months' time, it's priced in my opinion. What is not priced in is where the recovery is 18 months away.
And which would be?
I mean, see, there are select infrastructure developers. I mean, if you see, I mean, you have, the large state-owned infrastructure developers, right? Most of them are trading at very reasonable multiples. I mean, they've had a good run. It's not that you can't make another 10-15% per annum again from here onwards with them.
Sure.
But, they're not cheap, as, Whereas if you look at some of the private sector infrastructure developers, where perhaps, a turnaround or, balance sheet, problems being alleviated or, some kind of value unleashing strategies being, implemented, there I think, if you're willing to look past 6 months, if you're willing to look at 18 months, I think there is value.
So, would you believe that value now is in identifying pockets which will continue to grow at 20-25%, because the growth coming in at a valuation which is sub 10 times is just not there. So then therefore you find value in growth.
I think that's always going to be the case in a market like India.
More so now?
I think, I think, you have to really look at your investment strategy in a couple of, different buckets. So, there is obviously, the value bucket, which you and I were just discussing right now. But that said, I guess also in India, you have this advantage where, you have these stories which may be overtly expensive in terms of valuation multiples. But the good part about them is that, they are going to be compounding at 20-25% for the next 3-5 years, either because there is a market opportunity or because, they have the ability to take share from a relatively weak, system. And, if that's going to happen, then I mean, it goes on. It's like the retail private sector banks, for example. Look, I mean, when you look at them in terms of valuations and you say, hey, 3 times book, 4 times book, or, 15 times, 18 times earnings, you say, aren't they expensive?
So,
but,
perennially expensive.
They're going to be expensive because, they have that compounding opportunity.
Speaking of financials, since you brought it up, so are you at all willing to take a bet on PSU Banks on the assumption that there could be, there is already recapitalization, but that could be followed by some sort of reform?
I would selectively be willing to take that bet, Ira. But, what we have to appreciate is, look, recapitalization sorts out the issue of resolution capital.
Yes.
But, for them to be competitive in the marketplace, one, they will need growth capital. And when they go to investors asking growth capital, I think they're going to be asked the right questions. How are you going to sort out your processes and systems so that this kind of mess doesn't happen again? How are you going to compete in the new marketplace? I mean, in terms of digital banking for retail customers or sophisticated derivative products for corporate customers and so on and so forth. And all of them may not be able to give the right answers. Yep. Some will not be able to. And those who can give the right questions, is there an investment opportunity there? Yes. But I wouldn't say it's a broad-based opportunity. it's a selective opportunity for those who can make that leap.
And you have to get the right picks because there's no way of knowing, which banks the government will pick to push,
Exactly, and which is where, you need to, spend a fair bit of time assessing the managements, as you would in most companies anyway, and figuring out, who has the ability to, really make it to the next level.
Where do you stand on this NBFC story? I mean, again, there was much excitement, and we used to debate it all the time as to whether it's justified or not. Where do you stand on that?
See, I think, they had a very good opportunity, both on the asset side and the liability side. I mean, most of them tend to be wholesale borrowers. Yeah. So, a falling interest rate regime was very favorable for them. And then, you had the state-owned banks in particular completely distracted with credit cycle issues. And so there was a huge disintermediation opportunity. So now, on the margin, both these drivers are, if anything, receding.
Yeah.
Right? Interest rates are on the way back up, and, the state-owned banks will start pushing back. So I think, I'm not saying, they're all going to fare badly. But this was a rising tide which lifted all boats. Okay. Whereas what's going to happen is now we'll have to differentiate the men from the boys.
That's very interesting. Does this whole recapitalization stroke growth capital, assuming that all the QIPs are successful and they get enough money over the course of the next 6 months to fund the next leg of growth, set the stage beautifully for road developers? The reason I ask this to you specifically is because if I scan the 5 or 6 year-ender notes that have come out, non-JPMorgan, almost everybody is bullish on the road construction pocket. They believe Bharatmala will give this order book flips, which we haven't seen for a while now. I'm not saying you're not bullish, but I'm saying the others are definitely bullish.
We are bullish too. I mean, Niraj, if anything, like for more than 2 years now, I mean, we've been sounding like a stuck record on this, saying that, look, I mean, don't get carried away with a broad-based investment cycle recovery. The government's very clearly focusing on these 4 or 5 areas, and so, these will do well. And, roads is definitely one of the areas where, the data is trending in the right direction. You can see that very clearly. So, I mean, we are believers in that story.
Okay, so that's one pocket. The non-economy facing consumption has had a great run, and I'm not talking about staples, but the non-staples consumption has also had a fabulous move, more so on the stock markets than maybe what the actual businesses have shown. Is there a case for a pause, or do you believe that 15, 20 or 10, 15, 20% growth might continue?
See, Niraj, my take on this is that consumption in India will do well. I mean, given the demographics that you have. And urban probably more than rural, because urbanization is another trend that will just keep gathering.
Even post Gujarat, that's your view.
See, I mean, we're looking at structural trends. We're not looking at near-term tactical moves. So I guess consumption. I mean, there's a case to be made that consumption will grow at about 7-8% every year in volume terms. And if that happens, earnings can compound at 12 to 15%. There's no reason to believe that that will not happen. I guess the challenge when investing in that sector really is valuations, because what has really happened is, globally there was this chase for yield, right? And what happened was that in India, this particular, thesis manifested itself in money chasing consumption stocks. True. Because, we don't have a technology sector, at least not the kind of technology sector that, has done well in the last 2 years. And so I guess, it's a question of valuations. I mean, where do you find pockets where there is still value, and where people have defendable moats, and where you have valuations which are outright frothy and where they don't have defendable moats.
So is it more bottom up, or is it?
It is more bottom.
It's more bottom up.
It is more bottom up because top down everyone knows the story. It's been priced in. And if anything, I mean, investors have been very generous in the way it's been priced in. So you need to find moats which can sustain competitive positions and which can continue to grow.
What are the risks, Bharat, that are not priced in at a big picture level? Could it be a change in the government's thinking? Could it be interest rate hikes sooner than which is being factored in? What could it be domestically?
See, I think, if you ask me, I mean, sorry to digress, but I still think the bigger risk to markets, if you ask me, is global rather than local. Okay. Because, while we do need to focus on the local story, let's face it. I mean, 2017, the run in the markets was largely global. I mean, emerging markets went up 30%. India did more or less in line. But even the big global developed markets did 20% plus. So, I mean, and all this was, this was all underpinned by easy liquidity and easy monetary policy. So that has been the key driver of markets, because let's face it, in the last 5 years, earnings growth has aggregated mid-single digit. So I think, that's still the key risk to watch out for. From a local risk point, yes, I mean, I would certainly be worried with this discord that we are seeing increasingly over the last 3-4 months between the bond markets and the equity markets. That, the bond markets seem to be suggesting that, there are domestic stresses building up, either on the fiscal front or the inflation front or a combination, whereas equity markets have stayed quite immune to that. And while we do appreciate that equity markets are more driven by global factors, given that they're relatively more open, whereas bond markets are more locally driven because they're not so open, the fact is this is a discord that you can't see going on forever. At some point there's going to be mean reversion.
To the other.
So either the bond market gives up its worries and you see a big rally there, or the equity markets play ball, because if these higher levels of interest rates are sustained, then I mean it is also going to have an impact on growth. Okay. So yes, I mean one needs to this is one feature which one needs to focus on.
You were mentioning offline, sorry Niraj, I don't mean to dominate the conversation. You were mentioning offline about this whole stressed asset resolution. How do the equity markets look at this? I mean, from a macro level we can look at it in various aspects, but how would you look at it?
See, I think the equity markets have been quite sensible in the way they've gone about looking at this whole issue. They have been concerned about it on a structural basis, which explains the underperformance of the corporate and the state-owned banks vis-a-vis the retail private sector banks for some time now. And I guess, when the resolution capital was provided, that was priced in very swiftly, in almost 5 minutes, if I may.
Yes.
And after that, again, the markets now cooled off. The froth has, come down. And the markets are saying, okay, now, let's go through the resolution process. It's going to be
not from the perspective of banks. What about from the perspective of the industries involved, like steel, for instance? There could be massive reorganization in the ownership of steel in 12 to 24 months.
There could be. But, Ira, we'll have to appreciate that, see, steel is a global business. So I guess, the reason steel stocks have done well, and they've been doing well for some time now, I think since, late 2015, is because globally, I mean, metals have had a good run, particularly steel. So I guess, it's difficult to, start pricing in consolidation gains beyond a point, because, let's face it, we still need to go through the process, and it is going to be a long winding process. And secondly, even if you have consolidation, given where, I mean, it's an open economy, given where, import duties are, etc., you have to focus on the global picture rather than the local picture.
Sure.
Okay. 10-second answer, Bharat. Are you looking at biting into Bitcoin?
I really don't have a strong view on that. I mean, I've never looked at that asset class.
It's just been off 20% in the last 5 days. I thought you never know. People might be excited enough for Bitcoins as well. But Bharat, take a moment to thank you for joining us today on IndianOpen. And great having you.
Thank you so much for coming in.